Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered. Hello and welcome to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I am your host, Sarah, and today we will be talking about the stock market. Of course, we'll be talking about a decision by the Supreme Court that could have a major effect. We'll be talking about mortgages and retirement and planning for retirement. We'll be talking about a lot more. So let's go ahead and jump on in to our first topic, which is a bit of a wrap-up of the past week where stocks came off their first losing week of this year. And because it is the first losing week of the year, investors will be looking for the Federal Reserve to soothe markets by reaffirming its position that interest rates will be low for a long time into the future. The outbreak of the coronavirus in China in the past week took the steam out of a market that has been repeatedly rallying to new highs since December. The S&P 500 fell just about 1% for the week, amid fears the virus could lead to slower growth not only in China but across the globe. Those concerns could continue to spook markets in the coming week, but stocks should be buffeted by the Fed's anticipated commitment to low rates and its current Treasury bill buying program. The Fed meets Tuesday and Wednesday. Fed Chairman Jerome Powell is expected to emphasize that the Fed remains on a neutral policy path and that would only change if there was a significant change in the economic outlook. There are also some major earnings reports, including from Apple, which hit an all-time high Friday morning before closing lower with the broader market. It could have a big impact on sentiment and help influence trading across the technology sector. Stocks were choppy in the past week, and Treasury yields have been sinking on worries about the new virus. The 10-year yield sunk to a November 1st low of 1.68%, and investors drove gold prices higher in a flight to safety trade. It's overshadowing everything, said Quincy Crosby, chief market strategist at Prudential Financial. And what the market is looking for is that the Chinese are containing it and the spread is minimal, referring to the coronavirus. The derivative of all of this is, what does it do to growth? Traders and investors are hoping the stimulus that has been introduced into the Chinese economy is going to take hold, and this is not going to halt that turnaround. Crosby said the market has been looking for an excuse to pull back. The S&P 500 ended the week at 3,295, off 1%, but it is still up about 2% for the year so far. Crosby said you could see going into the weekend the 10-year Treasury yield is down, gold is higher, the market is in a textbook defensive state. We had a market that was poised for a bout of profit-taking, and this is it. There are more than 135 S&P companies reporting earnings in the week ahead, with a heavy focus on technology, industrials, and consumer stocks. Apple reports Tuesday, and Microsoft and Facebook are Wednesday. Boeing and General Electric report Wednesday, while McDonald's releases results Wednesday. On Friday, Big Oil reports, with ExxonMobil and Chevron expected. Earnings reports so far have been mostly better than expected, with 68.2% of companies beating earnings per share estimates, according to Refinitiv. Earnings are expected to be down about 0.5% for the fourth quarter, based on actual reports and estimates of companies yet to report. Coming into any earnings season with stocks at all-time high is fraught with peril, said Art Hogan, chief market strategist at National Securities. It's precarious because you have the opportunity for outsized moves if you miss earnings, revenues, or guidance. Hogan said companies may be able to give a better indication of the future now that there's a first phase trade deal between the U.S. and China. He said markets will be looking for guidance from China and elsewhere on whether the virus appears to be containable or not. The Federal Reserve is not likely to say much has changed in its outlook, except that its last three interest rate cuts, may have helped the economy and financial conditions. The big news is just talk on the balance sheet. I think that's going to be the key messaging, said Jim Caron, portfolio strategist at Morgan Stanley Investment Management. I think the data has been okay. There's really nothing new there. The only thing that's really new or interesting is going to be what's going on with the balance sheet. The Fed has been buying about 60 billion, that's not a thing. The Fed has been buying about 60 billion in treasury bills each month to expand its balance sheet, ending a program where it was shrinking the balance sheet. The Fed is adding reserves to end a problem in the repo market, which is basically the plumbing of the financial markets where institutions go to get short-term cash. Many traders believe the program is adding liquidity to markets and therefore driving investors into stocks. Mark Cabana, head of short-range strategy at BofA Securities, said the Fed is not changing its benchmark Fed funds target rate, but the fixed income market has been expanding the Fed to make a technical adjustment to another rate. He said the Fed funds rate, trading at about 1.55%, has come to the lower end of the Fed's target range of 1.5 to 1.75%. For that reason, it is not likely to raise the interest rate on excess reserves by 5 basis points. The intent is to affirm the bottom end of the Fed's target range, he said. Besides the technical move, they maybe will provide a little more guidance on what it would take to vote rates one way or the other, he said. There's an important date on the calendar in the coming week, including the first look at the fourth quarter's gross domestic product on Thursday. Personal income and spending data is Friday, and that includes the personal consumption expenditure inflation deflector watched by the Fed. New home sales could continue the string of positive news in housing when they are released Monday, and there are durable goods Tuesday. That is the report from this past week and a look at the upcoming week. In other news, the Supreme Court is hearing a case in March about the Consumer Financial Protection Bureau and could ultimately rule that the agency is unconstitutional. A case before the Supreme Court has the power to dramatically reshape how the U.S. government policies financial fraud and other misdeeds against consumers, which many experts fear would weaken existing protections and expose the public to more harm. The case, which concerns the Consumer Financial Protection Bureau, could ultimately lead to the dissolution of the agency, which lawmakers created in the wake of the 2008 financial crisis and was bestowed with broad powers to issue and enforce consumer protection rules in areas such as banking, student loans, credit reporting, mortgages, payday loans, and debt collection. Depending on their verdict, Supreme Court justices could also diminish states' power to investigate and punish financial wrongdoing. It would effectively be a big rollback in the consumer protection enforcement authorities, said Christopher Peterson, Director of Financial Services and a senior fellow at the Consumer Federation of America, a consumer advocacy group. There would be fewer deterrents for financial institutions to use tricks and traps to ensnare the American public, he said. Congress created the Consumer Financial Protection Bureau in 2010 when it passed the Dodd-Frank Financial Reform Law, giving it a mission to protect Americans from unfair, deceptive, and abusive financial practices. At the time, families were grappling with the effects of the worst financial crisis since the Great Depression, perpetuated by irresponsible lending practices that reverberated across the U.S. and global economies. Oversight of consumer finance was previously scattered across government, and laws escaped regular federal oversight, according to the CFPB website. The CFPB has collected billions of dollars in penalties from financial companies for wrongdoing. Its largest, for $2.13 billion in 2013, was levied against mortgage servicing firm Ocwen Financial Group, and a subsidiary for allegedly putting thousands of people at risk of losing their homes. The agency has recovered more than $12 billion for consumers to date, according to a Consumer Federation of America report published in March last year. The agency's activity has dropped off under the Trump administration, the report says. The plaintiff in the Supreme Court case, Sela Law LLC v. Consumer Financial Protection Bureau, questions the legality of the agency's unique structure. And we are going to talk more about this case and what is going on with it in just a few moments. We are going to take our first break of the podcast. When we come back, we'll be talking, of course, more about this Supreme Court case coming in March, as well as a look at mortgages and a story on retirement. As we go into the break, I want to talk to you about Birch Gold Group. In 2008, as we were just mentioning, the U.S. national debt was $10 trillion. Today, it's over $23 trillion, and it's rising like a hockey stick. If you don't think we're sitting on a house of cards, you're living with your head in the sand. But since you're listening to this podcast, you are clearly intelligent and smarter maybe than the average American. So what is your plan? As one of the dealers of physical precious metals in the United States, Birch Gold Group helps Americans diversify their savings with gold and silver. Customers can purchase for physical possession or convert a portion of their IRA or 401k into an IRA backed by physical precious metals. Can you afford another hit to your retirement like the last downturn when the S&P dropped 50%? You can hedge against inflation and hedge against uncertainty and instability with precious metals. Gold is a safe haven against uncertainty. Thanks to a little-known IRS tax law, you can even now move your IRA and eligible 401k into an IRA backed by physical gold and silver. It's perfect for those who want to protect their hard-earned retirement savings from any future geopolitical uncertainty. If you look back historically, when the bottom falls out of everything, gold tends to safeguard savings. So if this is something that you are interested in pursuing, you can contact Birch Gold Group to request a free info kit on physical precious metals. See if diversifying into gold and silver makes sense for you. This comprehensive 20-page kit reveals how gold and silver can protect your savings and how you can legally move your IRA or 401k out of risky stocks and bonds and into a precious metals IRA. To get your no-cost, no-obligation kit, go to birchgold.com/finance. That's BIRCH gold.com/finance. Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered. Welcome back to the GSMC Financial News Podcast. Before the break, we had started talking about the Supreme Court and the possibility that they could upend the Consumer Financial Protection as we know it. As I said before the break, the plaintiff in the Supreme Court case, Sela Law LLC v. Consumer Financial Protection Bureau, questions the legality of the agency's unique structure. The CFPB is run by a single director who serves a 5-year term and may only be removed for cause by the president. That, the plaintiff argues, gives the director an unconstitutional insulation from federal authority. Opponents of the agency, which receives its funding from the Federal Reserve, have called for Congress to structure it as a multi-member commission similar to a federal regulator like the 5-member SEC. The court is also considering if it should invalidate Title X of Title X of Dodd-Frank, the section of the law that created the CFPB, if the agency's structure is ruled unconstitutional. If that were to happen, it could upend the status quo of consumer financial protection. For one, it would dissolve the CFPB, but it would also curtail states' abilities to root out wrongdoing. That's because Title 10 of Dodd-Frank bestows greater power upon states to police financial rules. It allows states to enforce federal laws governing consumer protection, which are stronger than many of the states' laws, and blocks the federal government from preventing those state actions, Peterson said. States have used their expanded power to obtain hundreds of millions of dollars for consumers and penalize wrongdoers, according to a court filing made January 22nd by 23 states and the District of Columbia. The states outlined several examples. In 2018, 49 states sued PHH Mortgage Corp., a mortgage servicing company that ultimately paid $45 million in restitutions, penalties, and fees. In 2014, Illinois sued Alta Colleges, which forgave the debt of former students enrolled in its for-profit schools. It's doubtful that at least 5 Supreme Court justices would vote for this outcome, although the situation is murky given the conservative majority of the 9-member court, Peterson said. Oral arguments are scheduled to begin March 3rd. There wouldn't be an apocalyptic outcome if the court ultimately invalidates the relevant section of Dodd-Frank, according to the plaintiff. It would not eliminate federal consumer financial protection, the plaintiff said in a court filing. Instead, it would return authority under the 18 pre-existing federal consumer protection laws to other federal agencies. The plaintiff concedes, though, that Congress created the CFPB out of concern that federal agencies had not given their enforcement sufficient attention. Federal law would also no longer broadly prohibit any unfair, deceptive, or abusive acts or practices in the consumer finance industry if Title 10 were deemed unconstitutional, the plaintiff said. It turns out that the coronavirus spreading is also having an effect on mortgage rates, which hit reverse in the week ending January 23rd, falling by 5 basis points to 3.60%. In the week ending January 16th, mortgage rates had risen by 1 basis point to 3.65%. The weekly decline left mortgage rates at the lowest level in 3 months and about a quarter point above all-time lows, according to figures released by Freddie Mac. Compared to this time last year, 30-year fixed rates were down by 85 basis points. 30-year fixed rates are also down by 134 basis points since November 2018's most recent peak of 4.94%. Economic data was on the lighter side in the first half of the week. Key stats were limited to December's existing home sales figures on Wednesday and the weekly jobless claims figures on Thursdays. In a shortened week, the numbers had a muted impact on yields as the markets reacted to the global spread of the coronavirus. Demand for U.S. Treasuries rose in the week as the U.S. equity markets fell back from record highs. In contrast to the SARS and MERS strains, the latest strain has already made a global presence. Cases have been reported beyond China's borders, despite the government's best efforts to contain the virus. Perhaps the most alarming is the fact that some carriers can be asymptomatic while able to pass on the virus. The weekly average rates for the new mortgages as of January 23rd were quoted by Freddie Mac to be 30-year fixed rates decreased by 5 basis points to 3.60% in the week. Rates were down from 4.45% from a year ago. The average increased from 0.7 points to 0.8 points. 15-year fixed rates fell by 5 basis points to 3.04 in the week. Rates were down from 3.88% a year ago. The average increased from 0.7 points to 0.8 points. 5-year fixed rates slid by 11 basis points to 3.28% in the week. Rates were down by 62 points from last year's 3.90%. The average fee held steady at 0.3 points. According to Freddie Mac, the very low interest rate environment has clearly had an impact on the housing market. Both new construction and home sales have surged in response to falling rates, the rebound in the economy, and improving financial market sentiment. It is a particularly busy week in the week ahead. Key stats include December durable goods orders and January consumer confidence figures due out on Tuesday. On Wednesday, stats include trade data ahead of the Fed's first monetary policy decision of the year on Wednesday evening. The focus will then shift to fourth quarter GDP numbers on Thursday. From the housing sector, December's new home and pending home sales are also due out in the week. We can expect plenty of influence from the stats and the Fed. Outside the numbers, expect the new wires to also influence, as news of the spread of the coronavirus will likely continue to hit the wires. We are going to go ahead now and take our second break of the podcast. When we come back, we'll be taking a look at retirement. So stay tuned. You're listening to the GSMC Financial News Podcast, and I will be right back. Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand. Welcome back to the GSMC Financial News Podcast. We have been talking about the Supreme Court. We have been talking about mortgage rates, and now we are talking about the uncertainty of retirement. No matter when you retire, everyone has uncertainties about how that is going to look. The biggest challenge, of course, to retirement planning is dealing with that uncertainty. Financial markets, interest rates, and inflation are all difficult to predict and completely out of our control. Healthcare costs are a massive unknown. We all have unique personal situations that will affect our tolerance for risk and need for security. And, of course, none of us know how long we will live. This is all true for both traditional and early retirement. However, it can feel more manageable with traditional retirement. Anyone reliant on an investment portfolio to produce income deals with uncertainty in financial markets. This is manageable for those who've achieved a stable traditional retirement. Social Security provides an income floor. You can annuitize a portion of assets if more of a floor is needed. You could also consider a reverse mortgage. These options either don't exist or are not practical for early retirees. Some continued work, or at least maintaining the ability to return to work, are essential levers for early retirees to be able to pull to manage financial risks. Despite some people's misperceptions, Medicare is not free if you're looking in terms of healthcare during retirement. Still, it is a stable system with predictable and affordable costs. In contrast, we have constant uncertainty hanging over our heads. We have to reevaluate health insurance options on a year-to-year basis as the health insurance market continuously evolves. A clear advantage to retiring sooner is reclaiming younger and presumably healthier years of life to do the things that you desire, but there is a trade-off. From a planning perspective, retiring earlier creates more uncertainty. Dealing with uncertainty is something all retirees must come to peace with. Early retirement amplifies the magnitude of uncertainty, requires greater flexibility, and can create anxiety. I think the basic theme here with this article is uncertainty. Whether you retire traditionally or you retire early, there is going to be a level of uncertainty in terms of how you plan for that retirement and what it looks like. So before you even get to retirement, you have to have a plan in place for saving in general. And there's a term in the world that comes up a lot. I'm sure you've heard it. It's a word, adulting, which I have kind of a love-hate relationship with. I mean, I've used it before, but also it kind of makes me roll my eyes. But adulting with money, what we should know as younger folks when we go out into the workforce, I think it can be difficult to go from high school to college or trade school or whatever training you have to the quote unquote real world. And now you're supposed to be paying bills and saving money and doing all of these things. And many people don't have a good, educational basis in terms of what they've learned about money. So, money is like anything else that we need to learn. It can seem insanely complicated at first, but then bit by bit we learn more and we realize it's more accessible than maybe we thought. So even though the adult world has many confusing concepts, remember that most people are not geniuses, and yet they manage to navigate, and so can you if you are worried about money and planning and saving, etc. So gradually you will be a full-fledged salary-earning, tax-paying, money-saving grown-up. If that is something that you are concerned about, it will happen. Age doesn't matter as much as you think, says Paul Gaudio, a certified financial planner at Bryn Mawr Trust in Princeton, New Jersey. Someone who's 21 or 26 needs the same core principles of financial planning, investing, risk management, estate, and tax planning as people in their 30s, 40s, and 50s. It just changes in terms of focus, Gaudio said. On a starting salary that has to cover your monthly bills and get you through your days, you may have to do without some things, says Chris Campitsis, a CFP at the Barnum Financial Group in Elmsford, New York. We all have choices to make, he said. For some people, it's living in the suburbs and moving to the city when they get their financial feet under them. The biggest thing from job one, if at all remotely humanly possible, immediately start putting 10% of your money into your 401k, he said. Campitsis is firm on this strategy, if not the amount. If you can't do this, if you can't do 10%, he said, then do 5%. And if you can't do 5%, save 1% or 2%, but set a goal of raising the amount. Learning to live on less than you make from the start of your career means you'll never feel hamstrung by a lack of money. You'll always simply have built your lifestyle and your expenditure around the 90% habit, he said. Doing this now is far easier than it will be in 10 to 15 years when you could be dealing with wedding costs, mortgages, or children. It's good to learn early on how to squeeze the most out of your employer benefits. This is from Paul Gaudio. Maximize those benefits to the maximum extent possible. That means saving enough in your 401k to get the employer match if there is one. That is money you would not get if you didn't put in that contribution. If you feel squeezed by contributing to the retirement plan or an individual retirement plan, here's a government gift in the form of a tax credit. The Savers Credit for those with 401k plans or IRAs who aren't dependent on someone else's tax return and earn under a certain limit. The maximum Savers Credit can be as high as $1,000 for single filers and $2,000 for married filing jointly. To claim this tax break, you file Form 8880 with your tax return. Or Form 8880. That might be easier to remember. Even if you don't think you have much of value in that first apartment, get renter's insurance. You'll want to be covered in case of fire or theft, and you can get a rider to cover any special things such as a piece of expensive jewelry, a valuable painting, or a laptop. The average cost is about $16 a month, which is a small price to pay considering what could happen in case a neighbor lets their bathtub overflow. Most recent college graduates don't understand how credit cards work, Gaudio says. If they had a credit card account in college that their parents paid for, they may not have even seen the bill. In that case, they've learned to see it only as a way to pay for things. Learn to use credit responsibly. Gaudio recommends using credit cards for emergencies and relying on debit cards, cash, or checks for everyday spending. That way the balances never build up, he said. In your early 20s, you almost certainly have competing priorities and a starting salary. You may have student loans to pay down in addition to your other monthly bills. On top of that, you know you should have a couple of months' expenses stashed away in case of emergency, not to mention the need to save for retirement. Unless you're in a sales job with an unpredictable cash flow, there is good news, according to Gaudio. Your income is a known quantity, he said. There's a million ways to create a budget, and I always encourage people to create one. He says, list all of your fixed expenses, subtract from your take-home pay, and look at the difference. That's your discretionary income and allows you to make decisions. This way, he says, you'll know what you can afford and can't afford to do. One way to strengthen your position: treat an emergency savings amount as a fixed expense. I don't suggest all savings go into your 401k, he said. There should be also a cash reserve. So for those of you who may already be planning for retirement, that's information that maybe you've already implemented in your life, or maybe it's information that you're thinking, well, shoot, I wish I'd had that 20 years ago, 30 years ago, etc. But if you are just starting out in life, or maybe you're somewhere in that midpoint, then those are basic good recommendations for getting your money under control and hopefully helping to make retirement planning a little easier down the road. That's all the time we have for this episode. Thank you so much for joining us. Make sure you hit subscribe. Make sure you follow us on social media. Do all of those wonderful things. Give us a review, and we will see you on the next episode of the Financial News Podcast. Thank you so much. You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.